Welcome students. We are going to do partnership accounts in this video. The very first topic which we do while solving the partnership accounts is the maintenance of capital account of partner. We can do it in a two-way, which we are going to explain in detail in the coming video. There are two methods of maintaining the capital accounts of a partner when there is a partnership firm. The first one is fixed capital method and the another one is fluctuating capital method. In the fixed capital method, here the capitals of the partners remain fixed unless additional capital is introduced or a part of capital is withdrawn. That means here we make two accounts. One is partners capital account, the another one is partners current account. In the partners capital account, we keep the capital amount fixed as a credit balance only if there is any addition in the capital or a part of capital is withdrawn. That means not the drawings, a part is permanently withdrawn. Only those two type of entries are entered in the capital account. Otherwise its balance remains the same for the whole time or for the whole accounting period. So in that case, what we maintain the second account, that is partners current account. What partners current account has to deal with? It has to deal with all the items like share of profit or share of loss, interest on capital, drawings, interest on drawings, all these commission or salary, all these are separately recorded in the partner's current account, and it is as it is separately maintained, so its balance never affects the partner's capital account. Here the partner's capital account will always have a credit balance which will remain fixed until there is any withdrawal or addition to the capital. That means if the person has invested a particular amount, if during the particular accounting year he adds the amount to it or permanently takes out any amount, only then the balance will change. Otherwise the credit balance will always remain the same or fixed. That is why it is called a fixed capital account. Here the partner's credit account may show the debit or credit balance. It can have a debit balance or it can have a credit balance, but usually it should have a credit balance. The partner's capital account, what will be its treatment in the balance? The balance sheet, the partner's capital account will be shown on the liability side of balance sheet, and the partner's current account will be shown on the liability side if having a credit balance, and on asset side of balance sheet if having a debit balance. So that will be the particular treatment in the balance sheet. Now let us see the basic pro forma of capital and current account. Here is the partner's capital account when the capitals are fixed. By balance brought down, that is the opening balance, then by bank if any fresh capital is introduced, and then to bank if any permanent withdrawal of capital is there, and the balancing figure balance carried down will be the amount of capital at the end of the year. So this is the capital account in the case of fixed capital, when the capitals are kept fixed. And so here we will be making the partner's current account. What will be the entries there? The opening balance, by balance if the balance is credit, then by salary, the salary which he will be receiving during the year. Particular partner, individual account we will be maintaining for every partner. So by commission, if any commission he is to receive. By interest on capital if there is a provision. Then by profit and loss appropriation account, the share of profit, if there is a profit, then the profit we'll make the profit and loss appropriation account, and from that account, the balancing figure, the share of the profit of that particular partner will be entered here. And then to balance brought down, it means the balance, opening balance, if it is debit then it will be in the debit side. Then to drawings, to interest on drawings, and then to profit and loss appropriation account. If there is a loss in the firm, then the loss will be entered here. And then the closing balance, if it is credit balance, then to balance carried down, the closing credit balance will be entered here. And if the balance is debit during the year, at the end of the year, then by balance carried down, the debit closing balance will be entered here. So this is the method which we call where we maintain the capital accounts when the capitals are fixed. The another one method is fluctuating capital method. So here when we make the account, its balance keeps on fluctuating. We can say in this method only one account, that is capital account, is maintained for each partner. Means only one single account is maintained. All the adjustments such as the share of profit and loss, interest on capital, drawings, interest on drawings, salary or commission to the partner, etc., are recorded directly in the capital account. So here we don't maintain two different accounts. All the entries are collectively done in the particular partner's capital account. This makes the balance of the capital to fluctuate from time to time. So that is why it is called the fluctuating capital method. So here we are going, let us see the basic performer of this type of capital account. Here the partner's capital account, by balance brought down, that means the opening balance, and then by bank, if any fresh capital is introduced, by salaries, the salaries given to a partner, interest on capital, and then to drawings, to interest on drawings, and by profit and loss appropriation account if a share of profit is there, then to profit and loss appropriation account if the share of loss is there, and then to balance carried down, that is balancing figure. So here how we make the partners capital account, it is basically the collective account of with all the entries. So let us make it the things clear with the help of an example. Here A and B are the partners with the capital 1,50,000 and 1 lakh respectively. The profit sharing ratio is 3:2. Then how the following transactions will be recorded when the capital accounts are: number 1 fixed and number 2 is fluctuating. So let us check. The additional capital introduced on July 2019 by A is 3,000, by B is 2,000. Interest on capital is 5% for both. Drawings are for A 300, for B 200. Interest on drawings 18 rupees and 12 rupees. Salary 2,000 for A. Commission 1,000 for A and 700 for B. And share in loss is 6,000 for A and 4,000 for B. So let us see how the things are going to be done. The first case is when the capitals are fixed. So in this case, the we are going to record the opening balances as they were done: 1,50,000 for A and 1 lakh for B respectively. So 1,50,000 and 1 lakh. Then additional capital was introduced 3,000 and 2,000 on July. So the additional capital by bank 3,000 and 2,000, and then as the capitals are fixed, not any permanent withdrawal is there, so the balancing figure will be 1,50,000. The balance brought forward will be 1,53,000 and 1,02,000. Now all the other entries will be in the partner's current account. The partner's current account, as there are no opening balances, so only the entries will be there. Number 1 entry is interest on capital at the rate of 5%. So here is a basic we can say working note on that. let us see for A 5% on 1,50,000 for 1 year, that is 1,50,000 into 5%, it comes out to be 7,500. And then 5% on 3,000 for 6 months, 3,000 into 5% into 6 by 12, that is 75 rupees. So the total interest comes out to be 7575. And in case of B, we are going to solve 5% of 1 lakh. 5% of 1 lakh for 1 year, that is 1 lakh into 5%, 5,000 rupees. Then 5% on 2,000 for 6 months, that is 2,000 into 5% into 6 by 12, that is rupees 50. So the total comes out to be 5,050 rupees. Now let us come back to the problem. By interest on capital, as we have seen in the working notes, comes out to be 7575 for A and 5050 for B. Then the another is drawings, 300 and 200. So the drawings will be entered at this side, 300 and 200. Next item is interest on drawings. Interest on drawings is 18 rupees and 12. Then we have salary of 2,000 for A. The salary will be entered on the credit side for A, and then comes out to be commission 1,700. The commission comes out to be 1,700 for them. Now the last item is share in loss, 6,000 and 4,000. The share in loss is 6,000 for A and 4,000 for B. Now the balancing figure will be the opening balance or the closing balance of this year and will be the opening balance of next year. The balance carried down is rupees 4,257 for A and rupees 1,538 for B. So this is how we make the partner's current account separately. Now we take the second case when the partners capital accounts are fluctuating, or the fluctuating capital account method. So here in that case, when the capital accounts are fluctuating, we are going to have partners capital account keeping all the entries collectively. Like by opening the opening balance of the capital is 1,50,000, 1 lakh. Then by bank, the fresh capital introduced, that is 3,000 and 2,000. By interest on capital, as I have shown you in the working note, comes out to be 7,575 and 5,050. Salary of A 2,000. By commission 1,700. And then on the debit side, the drawings 300 and 200, interest on drawings, and then profit and loss, the share of loss which they got, and then the balancing figure will be 1,57,257 and 1,03,538. So this is how all the entries which we have done differently in the previous way, here all the entries are done collectively. One point that is to be noted is if it is not mentioned that the capitals are fixed, in that case while doing the practical questions, we always consider that the capital accounts are fluctuating and we maintain it in this way. So I think all the points of maintaining the capital accounts are clear to you. Thank you. Have a nice day.